The United States is on the verge of a bond crisis that most people are completely ignoring. Take a look. Bond prices are inversely correlated with interest rates. That means as interest rates go up, bond prices go down. And over the last 18 months, we've seen interest rates go higher and higher and higher. The side effect of these higher interest rates are that bond prices have been crashing. And this brings us to the natural next question. Who's holding on to all of these crashing bonds? Banks. Let me explain what this means by taking one step back. The United States government is not a for-profit entity. They generate their revenue by collecting taxes from taxpayers. So in 2022, the United States government collected about $4.9 trillion in tax revenue. Now, they take this money and they go out and spend it on things like Medicare and Social Security and infrastructure and military expenses. But if the United States government has expenses that exceed $4.9 trillion, they'll have to finance this money somehow. Like, let's just say in 2022, the United States government goes out and they spend not $4.9 trillion, but they spend, let's just say, $6.3 trillion. In order for the government to spend this additional $1.4 trillion, they have to go out and raise debt. And the way that the United States government raises debt is by issuing something called a treasury. A treasury is a loan that the United States government issues, and anybody can buy these loans. Banks can buy these loans, governments can buy these loans, investors can buy these loans. Anybody can buy these loans, and what that means is you are lending money to the government, and the government is going to pay you back with interest. Well, this is exactly what happened in 2022. The United States government had a $1.4 trillion deficit. That means they spent $1.4 trillion that they didn't have, and in order to finance this deficit, the United States government had to go deeper into debt by issuing these treasuries. And the issue is that the United States government has been running a deficit year after year after year for more than 2 decades now. And the question is now, what happens if the value of these bonds, these loans, starts to go down? Because a bond is a loan, and one type of bond is a treasury bond, a treasury loan, and a treasury is a loan that people or governments or banks can make to the United States government. Now that we've laid the foundation, let's dig a little bit deeper by answering 3 questions. Number 1 is who's been buying all these bonds that have been issued by the United States government? Number 2 is why have bond prices been falling? And number 3, what is the impact of these falling bond prices? So let's start by talking about number 1, who's buying all these bonds? This is a chart from the Federal Reserve Bank showing outstanding United States debt from the year 2018 until now. And what you can see is that after 2020, the United States national debt exploded. Now remember what that means. If the United States government is going deeper into debt, somebody has to finance the United States debts because somebody has to buy these treasuries. So who is buying these treasuries? Well, for the purposes of this video, I'm going to focus on 2 entities. Private banks, and then our central bank, the Federal Reserve Bank. This is a chart that Ray Dalio posted on his LinkedIn page showing bond holdings by commercial banks. And what you can see is that banks have a lot of bonds on their balance sheets, and this really exploded again after the pandemic. That means one entity that was buying all these bonds as the government was issuing them was private banks, and then we had the second entity, which is the central bank, the Federal Reserve Bank. Take a look. This chart right here shows the Federal Reserve Bank's balance sheet between 2018 until now, and what you can see is that after the pandemic, again, the Federal Reserve Bank's balance sheet really shot up. Now, the reason why anybody would want to buy treasuries or lend money to the United States government is because every economics book will tell you that lending money to the government is known as a risk-free investment. The government has the ability to always pay back its bills because it can generate taxes, and if they can't pay back their bills, well, then they can get their money from the Federal Reserve Bank. So it is an investment for private banks, and the Federal Reserve Bank kind of has this little arrangement to always finance what the government wants. Now, interestingly, the Federal Reserve Bank is supposed to be an independent entity. It's not supposed to be a part of the government. However, they have this kind of understanding that if the government wants to spend money, the Federal Reserve Bank pretty much has always financed that spending, meaning they, the Federal Reserve Bank, will go out and buy those treasuries. This brings us to question number 2, why are bond prices falling? And it's not just because the Federal Reserve Bank is raising interest rates. But before we jump deeper into that, I do want to let you know that if you are interested in learning more about how you can build your financial education and start investing, my team at Briefs Media wrote this amazing ebook on how to build wealth as an investor that'll walk you through from the beginning, the basics of how do you build the mindset of an investor, to how do you save your first couple $1,000s, to how do you start investing, to how do you start generating cash flow, to the different types of investments that you can make, to how do you spend your money smartly, to how do you earn money smartly, to how do you protect your assets. This ebook is packed with value. So if you want to get this ebook, it's completely free. All you gotta do is click the link down in the description below or go to briefs.co/ebook to grab your copy of this ebook for free. There are two big reasons why we're seeing bond prices fall. Let's start with the obvious, which is the higher interest rates. We already talked about in the beginning of this video how bond prices are inversely correlated with interest rates, meaning as interest rates go up, bond prices generally go down. Well, if you've been keeping up with any financial news, you know that the Federal Reserve Bank has been working to raise interest rates for the last year and a half as a way to fight inflation, and the impact of these higher interest rates are, well, bond prices are falling. But there's one more, a little less obvious reason as to why bond prices are falling, and that's quantitative tightening. Remember when I showed you this chart on the screen which shows the Federal Reserve Bank's balance sheet exploding after the pandemic? Well, it turns out that the Federal Reserve Bank is now realizing that all the quantitative easing that they did, meaning the money printing that they did to buy the treasuries, was actually inflationary, making the inflation problem worse. So now to reverse their causes of inflation, to fight inflation, the Federal Reserve Bank is doing what's called quantitative tightening as a way to now sell off some of their treasuries. In fact, the Federal Reserve Bank even put out a blog post on their website titled, "The Fed is Shrinking Its Balance Sheet. What does that mean?" And if you scroll towards the bottom, they have a whole paragraph titled that they are reloading for the next crisis. That means one of the largest holders of these bonds, these treasury bonds, has been the Federal Reserve Bank. Why did they buy these treasury bonds? Well, as a way to continue financing the government spending. But now the central bank, the Federal Reserve Bank, was holding on to all these United States treasuries, all these bonds. They had this huge balance sheet, and the way that the Federal Reserve Bank buys these bonds is by printing money, because the Federal Reserve Bank has the ability to do that. So they printed all this money, bought these bonds, racked up their balance sheet, and then they realized, oh no, our balance sheet is too big, because if we were to head into this another economic crisis, if we continued printing money to fund the government spending during that crisis, we could risk major inflationary problems, major economic issues. So we want to start selling off of our balance sheet. That way we, the Federal Reserve Bank, have the ability to print money at some point in the future. But what is the impact now of the Federal Reserve Bank selling off their treasuries? This goes back to now understanding supply and demand. If you have people selling an asset, what happens? Generally, when you have more sellers than buyers, the prices of an asset tend to fall. I mean, you could think of it in terms of home prices. If everybody in your neighborhood started selling their homes, what would happen? If you had more sellers than buyers of homes, generally home prices start to go down because now the sellers are bidding against each other to attract one of the few buyers. So now the Federal Reserve Bank is working to unleash or unload a big chunk of their balance sheet at the time where interest rates are also rising. Now, we already know the higher interest rates generally mean lower bond prices. Now, when you have lots of selling of treasuries, what does that mean? That also means now more treasuries are entering the market. As you have more sellers, the value of these treasuries tend to go down. Now, people buy treasuries, investors buy treasuries as a way to generate interest. It's like lending money. Why do you lend money to anybody? To generate interest. So now, if somebody is going out and wanting to lend their money to the government, they're going to need to be paid back with interest. And if you don't have a lot of interest or a lot of people who want to go out and invest their money, the government has to then incentivize you to want to lend money to the government. Like if they're not getting enough buyers for their treasuries, the government has to give you some sort of thing to make you want to lend money to the government. How does the government do that? By increasing interest rates. So now, as treasury yields rise, because people are not buying these treasuries fast enough, that also has an inverse correlation with bond prices. So the Federal Reserve Bank is raising interest rates. That makes bond prices fall. In addition to that, now treasury yields have to rise even further because the Federal Reserve Bank is selling off their treasuries. That also makes bond prices go further. And now that you have a bigger supply of treasuries available for sale, the government needs to incentivize people to keep buying these treasuries, which makes yields go higher for the bonds as well. Higher yields lead to lower bond prices. And who's holding on to these bonds? Well, we already know the Federal Reserve Bank is holding on to these bonds, but they bought these bonds with money that they printed out of thin air. However, you also have a lot of investors like banks holding on to these bonds that are now underwater, which brings me to question number 3, which is what is the impact now of these lower bond prices? Well, we started to see an impact of the lower bond prices back in the early part of 2023. Remember when we saw Silicon Valley Bank collapse and we saw the big banking crisis where banks were starting to fail because they were underwater on some of their assets? Well, which assets were they underwater on? Not surprisingly, they were underwater on their treasuries. They were underwater on their bonds. Why were they underwater on their bonds? Because of everything that we discussed in point number 2. Well, what has happened between April, when we started to see this banking crisis, and today? Well, interest rates have gone up even further, and treasury yields have gone up even further. That means bond prices have more downward pressure since before, when the banking crisis happened. That means the issues that caused the banking crisis didn't get better. In fact, they got worse. Now, what had happened in the banking sector is that we saw the FDIC and the Treasury Department and the Federal Reserve Bank come out and create new lending programs that with banks that were struggling could go out and borrow money to continue staying afloat and continue operating. However, the underlying root cause of the banking issues didn't get better. In fact, they've gotten worse. And it doesn't look like interest rates are coming down anytime soon. So now you have banks that are holding on to these assets, these bonds that are underwater. Now, if that bank ran into any sort of, let's just say, liquidity issue or any financial issues and they needed to raise more money, you can't go out and raise money very easily on an underwater asset. I mean, think of it this way. You go out and you buy a home for $500,000 and you have $400,000 worth of debt on it. Tomorrow you find out that your home is only worth $300,000. You got an appraiser, they said it's worth $300,000 and you wanted to refinance. You have $400,000 of debt on a $300,000 home. No bank is going to want to lend you money on that refinance because they're lending you money on an underwater asset. This is the same situation with banks. You're seeing more and more banks that are sitting underwater on a lot of these assets. And if they start to run into more financial struggles and they need to raise money, they could struggle. Now, of course, we have seen the FDIC and the Treasury Department create these new lending programs to keep some of these banks afloat. However, not everybody can benefit from those lending programs. You have other investors and other institutions that are also owning these bonds that are underwater. Now, if you hold the bond to maturity and you just keep getting your interest, it's not as big of a deal. But if you have a lot of your assets tied up in these bonds and you needed to sell and you're underwater, or you needed to raise debt on these bonds that you're underwater on, this is where now you can run into financial problems. So, understanding now how bonds work is important for you as an investor because, well, it shows that if bond yields keep rising, the owners of these bonds will continue to suffer. And we have seen bond prices fall pretty significantly over the last 18 months or so. And if interest rates continue to stay high, or if they go even higher, that's going to continue to hurt bond prices. And again, that's going to hurt the bond holders. And this is where it's important for you to understand because while bond yields are rising, that also creates opportunities now for people to buy these bonds to get better rates. But this is where it's important for you to understand what's happening because this also creates other risks in the economy. Again, your job is not to be somebody who worries about what's happening, but rather understands what's happening. That way you can capitalize on financial opportunities that might come your way because every turn in the economy creates opportunities. But it only creates opportunities for those who are financially educated and who are financially prepared. And that means it's important for you now to start building that financial education and start understanding what's happening. And of course, we have our free ebook at Briefs Media that you can read that can help guide you on that financial education as well.
If you want to be an overpaid employee, there are 3 things that you have to understand. Number 1 is you have to understand the company's financials. Number 2, you have to know how to make yourself irreplaceable as an employee. And then number 3 is you got to know how to get your piece of the pie, meaning how do you get that overpaid salary now? Now, I have hired and fired multiple people at